One question that always comes up is about the riskiness of investing in the futures markets. Many people perceive, as I mentioned earlier, that futures are a risky investment. Now, I've argued earlier that it actually, if you're involved in hedging, the futures market is risk reducing. In the agricultural example, the farmer was able to protect the value of the crop by engaging in a short sale in the futures market. Now, it's clear that futures can be speculative and lead to risk enhancement. For example, if the farmer decided to go long in the futures market, then basically the farmer is doubling the risk that the farmer already bared with an unhedged position. It's also the case that just regular investors in the futures market that are not hedging are subject to some volatility. And what I want to explore is what that volatility actually is. Now, it turns out that the degree of risk that you bear by taking a futures position is very much dependent upon the margin that you put up. Let me take an example. And suppose that we are investing in stocks. One possibility is that I take $1 million and buy stocks that mimic the Standard & Poor's 500 stock index. And if I do that, I collect the dividends on the stock and take all of the capital gains. Another possibility is that I take the $1 million invested in a money market account and take a long position in the Standard & Poor's 500 stock index with an underlying amount equal to $1 million. Now, in this case, I benefit if the stock price goes up, and that's really identical to the benefit that I would achieve if I was just invested in the $1 million portfolio of actual securities. So I've got two ways I could invest in the market. One way, purchase the stocks, collect the capital gains and the dividends. The other way, take the $1 million, invest it in a money market deposit, and go long in the S&P 500 futures. The futures investment, I collect the capital gains on the stocks. I don't get the dividends because I do not actually own the underlying securities. But I do get an interest rate of return because I've got a $1 million deposit in a money market fund. Now, it turns out that this particular way of investing would lead to virtually identical volatility as just buying the stocks with the $1 million. Remember, the volatility is a measure of the standard deviation of the returns that I expect. The volatility of buying the S&P 500 stocks and holding them, and the volatility of taking a long position in the S&P 500 futures is basically the same. Now, I've made the special assumption here that we put exactly the value of the underlying futures in a money market deposit. And this is known as a 100% margin position. So basically I take the exact amount and put it in a money market deposit. In the example that I always go back to in terms of perhaps speculating on the price of corn, if I had a contract to purchase 1 million bushels of corn at $4, then I would put $4 million in the money market account, and that would be 100% margin. Now, it turns out that it's not that usual to put 100% margin on. But the thing to realize is 100% margin guarantees that the volatility of your futures position is the same as the volatility of the underlying asset. Whether it's corn, whether it's the Standard & Poor's 500, whether it's gold or pork bellies. 100% margin position ensures that you bear no additional risk over and above the possibility of simply purchasing the underlying asset. Now, where the risk can actually increase is where we take a margin position that's less than 100%. For example, I don't need to put 100% down. In my Standard & Poor's 500 example, what I could do is I could still put $1 million in a money market deposit, but I could control $2 million worth of the S&P 500 futures. And this would be a margin position of 50%. Now let's kind of think through what this actually means in terms of my portfolio returns. If I just bought the stocks for $1 million, and suppose that the market goes down by 10%, then I lose $100,000. And if the market goes up by 15%, then I would make $150,000. Now let's consider the situation where I'm using the futures, but I'm going to be levered in that I'll have 50% margin. So again, I have a $1 million investment in a money market account. I control $2 million worth of the S&P 500 futures. Suppose the market goes down by 10%. 10% of 2 million is 200,000. So I would lose 200,000. Suppose the market goes up by 15%. Well, I'm going to make $300,000. So notice what's happening here. As I go to 50% margin, the swings in the value of my equity actually increase. They actually double. So instead of losing 100,000, as I would if I bought the securities, I lose 200,000. Instead of gaining 150,000 as the market goes up, I gain 300,000. Now you can see that the volatility of this position is exactly double the volatility of holding the underlying stocks. Now we could go to more extreme levels of margin and leverage. If we had a 10% margin rate, then I could control $10 million worth of the S&P 500. However, if the market goes down by 10%, instead of losing 100,000, I lose everything. I lose $1 million. My money market account is completely cleaned out. Then, on the other hand, if the market goes up by 15%, I stand to gain $1.5 million. So you can see, as the margin goes down to a lower rate, the volatility of my position increases. Now, one thing that's rather interesting is how these margins are set by the exchange. Well, the margin is like good faith money. And it turns out that the margin is different in terms of the percentage of the underlying contract depending upon the underlying contract. So something that is not that volatile, such as a treasury bill, has a fairly low margin deposit because the price doesn't fluctuate that much. Whereas something like the S&P 500 has a rather large margin that's required. So The margin is set to reflect the volatility of the underlying commodity that we're looking at. Low volatility commodity implies a low margin. High volatility commodity implies a high margin. And roughly speaking, the margin is usually set at about 4 times the volatility. So margin is the mechanism whereby you can set the risk of your position. So if somebody says that, well, I don't want to invest in futures markets because they're too risky, it's clear that this person doesn't really understand the fundamentals of futures trading. You determine what the volatility is. You determine how much margin money to actually put down. The risk is in your hands.